although some are warning that oil prices might hit $200/barrel in the next year, it is just as possible that they will retreat to $60, depending on a wide variety of developments. The reasons for higher prices include sanctions on Russia, Iran, and Venezuela keeping as much as 5 MB/d off the market, most of that already shut in, but also, underinvestment in upstream activity squeezing future supplies while the global economy, and oil demand, return to and surpass pre-pandemic. These are serious concerns and point the way towards the ultimate bull market, where prices would be far above historical levels. On the other hand, as economists often say, there are a variety of things that could lead to much lower prices in the coming months, and this article will describe what can serve as warning signs of that. A caveat: I have a long history of bias towards predicting lower oil prices, and while I have often been right, I have also often been wrong, especially when political developments unexpectedly restrict oil supply. In 2008, just before the oil price collapse from its heights, I published 2 pieces called Investing for the Oil Price Crash. At the time many were warning of $200/barrel prices, but I thought the market was in a bubble and said so, to the opprobrium of many readers. That the prices dropped a month later did not represent amazing foresight on my part, but luck. 2 things that seem likely to presage lower prices. Today's, June 8th, a weekly petroleum statistics report will give a sense of gasoline demand for this summer, as the product supplied numbers might dip because retailers discover that post-Memorial Day driving is less than expected. A weak driving season would pressure gasoline prices and refiners' margins. Second, the June 15th release of the IEA's oil market report is almost certain to be bearish, with demand expectations downgraded and estimated Russia supply losses reduced. See below. Next, the global economy. 6 months ago, the world economy was booming, the pandemic appeared nearing an end, and inflation was thought to be transitory, requiring no central bank action. Now, both stocks and bonds are down, bitcoins are crashing and consumer confidence has been moderating. Inflation is raising fears that another recession is imminent, in part because of central banks' deflationary moves. The greatest danger is of deflationary contagion, that is, a collapse in prices of a major asset group causing a retreat into cash, pushing down asset prices more generally, including those for commodities, and threatening recession. Of course, many such assets fluctuate wildly in these uncertain times so that any given day or week's drop may not persist. Still, the degree to which asset prices drop and reduce global wealth is a major indicator of possible economic slowing.